one of the things I wonder, Dan, is certainly, I mean, we're observing this with some companies and some things that we went through a portfolio threat analysis. We were looking at one business that had a low cost labor manufacturing advantage in Mexico. And what had happened over time is the business had competitors that through technology actually built systems that were better than the fact of the comparative lower cost labor advantage that it once had in Mexico. So I wonder with advanced technology, machinery and so forth, putting artificial intelligence aside, just general machine impacts, I wonder how much that might help a developed economy that has higher labor. Do you think that might help reduce or negate the comparative advantage of lower labor? Any insights on that?
I think
Probably a more medium to longer term view, not certainly a short term one.
it should. I mean, investing in robotics and automatization is key. The issue here, of course, is that the leader in that is China, not the United States.
Yeah.
By a significant factor. So I think that's the future. If you want to bring back production, it has to be capital intensive. We have capital, we don't have cheap labor. We can have skilled labor, we can reskill it, but the idea that you're going to produce again t-shirts in Western Massachusetts or textile,
Yeah.
I don't think that's coming back unless you completely automate it. Now, and you see this pattern. I mean, you actually see how capital-intensive industries are starting to return. This is the CHIPS Act mostly, so it's from a few years back. Chart on the left shows FDI manufacturing construction picking up in US and Europe as opposed to China. Now, the chart on the right shows where that is happening, and it's all happening in capital-intensive stuff, computer, electronics as a percentage of total. It's pretty clear. This is, again, chips, but to the extent there are subsidies, tariffs, and tax corporate incentives.
Some of which is impacted by that rare earth advantage or challenge potentially coming from China, which is interesting when you look at the kind of industries that could be impacted from the necessity of getting that rare earth dependency currently from China.
That's going to be a significant challenge. I agree. And unless there is a deal with China to reduce tariffs, they're going to be reduced to the previous levels. But have some sort of modus vivendi. I think that this will remain. That will be a significant headwind, especially even for aerospace and defense, which I'm bullish on in all these major industries. Eventually, you can build rare earths. It's all processing, but it takes half a decade or more. I mean, it's not something that can be done overnight. So I agree. I think that will be a headwind for this. Manufacturing, again, as I mentioned, it is not going to come back really. I'm not going to go through the details, but the tariffs in 2008. 2020 did not bring back manufacturing or jobs, chart on the left. And the chart on the right shows that while manufacturing employment in the United States dropped after China joined the WTO in 2000, most of the big drops, the lower panel, were 2 years after a recession. So recessions in many ways are the trigger point, even if there's a longer term trend in actually reducing manufacturing jobs. So there's a fair chance that tariffs are counterproductive if they induce a recession and we actually lose manufacturing jobs, which would be the opposite of what the Trump administration wants. Now, as I said, we're bullish on U.S. equities. I mean, we always say there's going to be correction in the first half of the year. I think we're there. I think if tariffs calm down and you have certainty, if you have deregulation, if you have tax reform, there's an argument to be made that panic maybe has peaked. Chart on the left, and maybe U.S. equity valuation longer term is in terms of forward Ps at average. So again, it's becoming a cheaper buy, although it's still, as you mentioned, quite expensive relative to the rest of the world. Now, really quickly, in terms of national security implication, the world is rearming. That's pretty clear. Chart on the left. We'll continue to. The Europeans, the U.S. also will spend more on defense. Aerospace and defense equities. You've been telling clients since 2023. This is a buy. This is a strong area that will grow in geopolitics. It still continues to have massive geopolitical tailwinds. Of course, these stocks are expensive and very much so in Europe and APAC, the bottom two panels. In the US, they're actually sort of a benchmark. And if the US avoids a trade war with Europe, it's going to sell military gear to Europe. It's going to spend more. The Trump administration wants to increase procurement. So I think that overall, and especially in Europe, but especially in the US, but also in Europe, maybe there is more room to run. Although, I'm not an equity analyst, these things are quite expensive. Of course, you have a number of ancillary industries that benefit from this. The other play here, longer term in terms of commodities, industrial metals. As the world rearms, that usually correlates quite nicely with military expenditures. Here I have the US, which is a good global proxy. So to the extent that we have geopolitical tensions and the world is rearming, which it is, I think industrial metals, even if not in the short term, if we have an economic downturn, are an interesting play from a commodity perspective. Now,
one of the other things that we've been looking at on the defense aspect, Dan, is what are some of the different service industries servicing that investment in defense that's likely domestic, and where can you find the tailwind thematic benefits without having to pay the high price to get into it through a larger public company or something of that nature has been one of the areas that our team's been diving into.
It's almost picks and shovels for defense.
Yeah, exactly.
Makes a lot of sense. The other thing I would say is I've been very bearish for political reasons on alternative energy. Again, massive political pushback in Europe, in Canada, and the United States. The IRA Act may be gutted by Trump, but I think it's reaching a bottom. If you look at the chart on the right, which is global alternative energy, it's finally kind of cheap, which wasn't last year. At some point, once subsidies are removed and once mandates are pushed back, this industry will have to stand on its 2 feet, and it's getting close to bottoming out, I think, this year or next. In the meantime, as I said, I'm still wary about it. I'll highlight a play in this that makes sense. But the other play is nuclear and uranium. As countries have AI, they need to rearm, reindustrialize, you need cheap energy. Well, nuclear is a cheap form of energy. The Russians, the Chinese, the Indians, the Europeans, even the US are starting to build more, to recommission old nuclear plants. I mean, since 2023, uranium and nuclear has had a good run. It's dropped recently, but it still outperforms any other form of energy. I think it will remain sort of the elegant way to get cheap energy and to decarbonize. So it's kind of killing two birds with one stone. So I'm bullish on it from a policy perspective. The other things I would say is in the energy space, if green energy is still controversial and still faces tailwinds, chart on the right shows, again, global investment and energy transition. But the one thing that's not politically controversial is rebuilding electric grids. Anybody wants that. Trump wants that. Every right or left-wing party wants that. So my view is that if you want to invest in green stuff, invest in grids, because all the grids are ancient and they have to be rebuilt.
And again, service type of businesses that serve all that building, repairing, and so forth, as well as we think about the U.S. economy and other economies that everybody wants to invest behind that.
Absolutely. The CapEx is supposed to expand in terms of electricity and capital expenditures, chart on the middle. And, if you look at this, it's a national security important sector. So going back beyond aerospace and defense. So if you look, even IT, which is, okay, you can say US IT is atrociously expensive, it's coming down now, but it's important to the US strength. But if you look at that, machinery, electrical equipment, I mean, I think that from a political perspective, leaving aside valuations and movements in stock markets, chart on the right, those are industries that are going to get support from Washington. And they are. In one form or another. Now, the other thing I would say is with that, if you put everything on the grid, you create a single point of failure. So I'm really big on cyber. You have to protect that again. And cyber security is becoming increasingly relevant as many countries are using cyber as a form of, gray zone warfare, hybrid warfare. So in that sense, your cost of cybercrime, of course, they're increasing massively, chart on the right, but so is the cybersecurity market size. And, if you look at cyber asset performance, it's more or less on par with the overall MSCI return. So I think, of course, you had a CrowdStrike problem last year, but I think this is going to be a growth industry because, again, if you have to protect critical industry, critical infrastructure, this is one way to go, and you need it. I'll turn it back to you, Brett.
Yeah, Dan, thank you very much. Incredibly insightful, great information. Thank you to all the Alpine Macro team for putting together very clear, concise data and charts so that we can all absorb and see what's happening and how things may create correlations into different threats and opportunities in various sides of the market. We hope you all enjoyed this as part of Star Mountain's Market Insight series. Again, thank you, Dan. Phenomenal information, and to the entire team at Alpine Macro.
Thank you very much. Pleasure to be here.